profit volume ratio, which is the PV ratios. And I remember that we started this topic in our last discussion, and I feel we should start all over again on this very topic. So we'll talk about the PV ratios. The total contribution divided by total sales is called profit volume ratio or contribution ratio or PV ratios. Break-even point can be determined with the help of a PV ratio. Remember, we talked about the break-even point. We say break-even point is a point whereby your total sales or your total revenue is your total cost. There's no profit, there's no loss. That means you break-even point. That's a break-even point. We have break-even value of break-even unit. Break-even point in unit and break-even point in value. The one in value is the naira value of how much if you sell and how much if you incur as a cost will be equal. That is what we call the break-even point in value. Then the unit, that means the quantity that when you produce, you neither make profit nor make a loss. Now, we can also calculate our break-even points using the PV ratios. And they say the formula is what? Is contribution, total contribution divided by what? Total sales. So we say PV ratio is cost to what? Contribution divided by sales. And of course, contribution is what we said, sales minus variable cost. Sales minus variable cost is what is our contribution. If you can see it here, sales minus variable cost is contribution divided by what? Divided by sales. We can say it 1 minus variable cost over sales. Still give you the same thing. Or we can say PV ratio equals to your fixed cost plus the profit divided by sales, or FP plus P, F plus P over S, where F stands for my fixed cost, and then P stands for the profit, then S stands for my sales. So remember, we talk about fixed costs. I hope you've not forgotten. So fixed costs are costs that does not change with the level of activity or the level of production. Whether you produce or you don't produce, you still incur that cost. I give an example of what? Rent of a factory, where you have a pay rent on the factory, and then whether you produce 1 million units or you don't produce, that rent is still there. So it's fixed. It's not affected by any level of activity. So that's what we call fixed cost. And the profit, we know what profit is. Profit is what you have, your sales minus cost. What you have is your profit. So when you add profit, then you divide by your sales, will give you what? Your PV ratio or profit volume ratio. Now, the break-even point in value, which is what? Fixed cost times total sales over total sales minus variable costs. That is fixed cost times total sales divided by total contribution. Remember, we will say contribution means what? Is sales minus variable cost. That is as SP, selling price, minus variable cost. Let me just do some small analogy here. We say it's cost price minus selling price minus, what is my, okay, sorry. No, okay, this is it. Now, we say contribution. Of course, this is what we've been talking about. Contribution is equal to your selling price, which stands on which HP stands for. SP stands for less your cost price. Sorry, less your variable cost, sorry, equals to what? Contribution. Now, if we have fixed costs plus multiplied by total sales, cost to contribution is what? Is our PV or break-even point in value. Then the fixed cost divided by total contribution divided by sales, same thing as what? You can change this formula, you can manipulate this formula to get what you want. Now, the fixed cost divided by PV ratio will give you what? Break-even point in units. Give you break-even point in value. Now, let's go ahead. Now this is it. We say variable cost to sell cost, and variable cost to sales is called variable cost ratio. Now, break-even point in value equals to fixed cost divided by 1 minus variable cost over sales. That firm producing one product line only, calculation of break-even point is preferred in units, and firm having a variety of product lines, calculation of break-even point is preferred in value. PV ratio can also be expressed in the form of percentage by multiplying by 100. Look at the illustration below. So what this paragraph is saying is that when you are talking about when you are handling one or single line of product, you don't have multiple product. So it is best to use break-even point in units. When you have multi-product, when you have more than one product, you use what? You use the break-even point in value. That's what this one is saying. Now, if you look at this marginal costing and cost volume profit analysis. So for example, XYZ Limited is manufacturing and selling 4 types of product A, B, C, and D. The sales mix and variable costs are as follows. For product A, we have the sales per month is 200,000, and the variable cost, so the variable cost ratio is 50%. Then product B, the sales per month is 450,000, while the variable cost ratio is 50%. And product C, the sales per month is 100,000, and the variable cost ratio is 50%. And then product D has a sales of 250 per month, and also has a variable cost ratio of 50%. So the fixed costs are 150,000 per month. Required, calculate a break-even point. So this is what we're giving. We want to know, okay, at what point or what quantity or what value if we produce or if we incur, that is where we will not have neither profit, we have neither profit nor loss. That's what we're talking about, break-even point. This is what we have. Then calculating the variable cost and contribution is what? So we have the sales. Remember, product A, B, C, D. This is what we have from this table here. We just change the table the other way around. Now, product A, the sales is 200,000, B 150, C 100,000, D 250. When you add together, you have what? 700,000. Now, the variable cost is what? We're told that the variable cost is what? The variable cost ratio is what? Is 50%. That is 50 over 100. Then multiply by each of the sales per month. As 50% of this, let me just do it here. It will give us 50%. For this one, I'll say 50%. That is 50 over 100 for product A. Price A now will be multiplied by, of course, that's the sales of 200,000. We'll now multiply by 200,000. So it's 200,000. I'm not using a mouse. That is why I'm having this. So by the time you cancel this, 0, cancel 0 if you want. 0, cancel 0. So we have 5 times 20,000 is what? That will give us 100,000 for product A. That is 100,000. In other words, almost 50% is what? Is a half of this. 50% is the same thing as what? Half of whatever you have here. So half of 150 is what? 75. Half of 100,000 is what? Is 50. Half of 250 is what? Is 125. But by the time you add all these variable costs of the various product A, B, C, D, you have 350,000. Now, this is what? Is a fixed cost. How much is the fixed cost? given to us. We have fixed cost of what? Of 150,000. So the profit is what? Profit is 200,000. How did you get that? 700,000 minus 350 minus 150 will give us 200,000. Now, the PV ratio equals to total contribution divided by total sales. So what's total contribution? Is what? Is 350, because contribution is what we said is sales minus variable cost. So this what is 350. 350 is the total contribution. Now that's total contribution because it's 700 minus 350 is 350. Remember, we said contribution is what? Sales minus variable cost. This is our sales. Our sales is 300 and 700,000 naira, and then our variable cost total is what? Is 350. You can do it individually to give you the same thing. But I say this is 200 minus this, you give us 100. You give us 100,000. This will give us 75. If you do it individually, we'll still give you the same thing. This will give us 50,000. This will give us 125,000. 125,000. That is it. If you call it what? The contribution. This is our total control. This is our contribution. That is our contribution. Our product. Now the last column will now give you our total contribution. This is this one. Now we'll say total contribution or total sales. Total contribution is 350. Look at it here. It's 350 I have here. Divided by sales. Sales is what? 700. That will give us what? 0.5 or 50%. That's our contribution. That is our PV ratio. Profit volume ratio is what? 50%. Now, having gotten our PV ratio, now the break-even point is equal to 150. That is 150 is what? Is our fixed cost. Remember, we said what? If you go back to the formula, we said fixed cost divided by contribution. That's fixed cost plus profit, total sales, but this is fixed cost what divided by total contribution divided by sales. So we have our fixed cost as what? As 150,000 naira. And our contribution, PV ratio is what? 0.5. Or you say 150, 150 divided by 0.5 will give you 300,000 naira. So the variable cost ratio equals to variable cost over total cost, which is what? 350 divided by 700,000. That will give you 750%. Now, the break-even point in value can also be done like this, using the other formula is fixed cost divided by 1 minus variable cost divided by sales. So the fixed cost, if you do this one, the fixed cost is what? Is 150. Then 1 minus variable cost divided by sales is what? You still get the 0.5. So we do either of the formula, you get the same figure of what? 300,000 as what? The break-even point in value. That is, for this company or this XYZ, if they want to break even, they want to make sure that they have neither profit nor loss. Their sales must be 300,000 naira as well as what? As their costs. Their revenue should be 300,000 naira, and then their cost should be 300,000. There will neither be profit nor loss. That's the break-even point. Now, anything, if they sell above 300,000 naira, they will be making profit. But if they sell below 300,000 naira, they will be making a loss. They will be making a loss. That's what this one means. Now, let me just do some small illustration here. Let me use some graphical illustration so that you understand what I'm saying. At break-even point, we said sales or revenue is equal to costs. Revenue is equal to cost. So let me just draw my graph here. I have my X, I have my Y. This is X, which stands for my sales or my revenue. The sales revenue. This is my cost. The Y stands for costs. The Y axis is my cost. So let's assume this is 100,000. It's 100,000. 200,000. 300,000. 400,000. And let's say we have 500,000. This is our sales or sales revenue. Now this is my origin, which is 0 here. Here, let me have the same, let's say 100,000 as the cost. It can be different. Let me just use this same figure. This is 200,000. 300,000. 400,000. And then let's say 500,000. I remember from the question we have that our fixed cost is how much? It's around 150. This is 100. 150 will be here. So it goes like this. This is the line for my fixed cost. Fixed cost line. Now, if you begin to produce, if you look at this, from here we said what our break-even point is where the cost is equal to what? Is equal to the revenue. Let's assume this is it. At this point is what we call the break-even point. Break-even point. That is at the point whereby your sales, your cost is equal to your sales. Now, anything to your right here, any sale you make to your right to give you profit. It gives you profit. And any sales that you make below the break-even point, you will incur a loss. So from this graph, you understand that the break-even analysis helps you to what? Determine the level of activity that you want to achieve to make a certain level of profit. So if you know that, okay, if you produce 300,000, you will make a break-even. So if you want to make profit, you must at least produce above 300,000. That's what it means. Now let's continue. Let's continue. This is just by the way. Let's continue. So from this, we say is what the break-even point in value will be 300,000 naira. That is the point at which the XYZ will never make a profit, will never make a loss. So it will be able to what recoup whatever it has spent. Let's look at example 2. The ratio of variable cost to sales is 70%. Take note, the ratio of variable cost to sales is 70%. The break-even point occur at 60% of the capacity. Find the break-even point. Break-even point sales when fixed costs are 30,000 reals. Also compute profit at 35% of the capacity sales. So this is one of question that is from India. And if you look at their currency, is Indian currency. So we said what the break-even cost, the ratio of cost, the variable cost to sales is 70%. The break-even point occur at 60% of the capacity. Find the break-even point sales when fixed costs are 90 RS. Also compute the profit at 75% of the capacity. This is just the question. So this is how we go about it. As the variable cost to sales ratio equals to what? 70%. And we know that PV ratio or contribution ratio equals to what? 1 minus VC over sales. So 1 minus VC over sales. So we say to what? 1 equals to minus 0.7. Because we have our, if, let's go back again. If the ratio is 70%, 70% is what? 0.7, right? 0.7. So we now say, okay, this is 0.7. Is the whole of this will give it to us as 0.7. So 1 minus 0.7. Of course, the VC over sales is what? 0.7. That is 1 minus 0.7. Now, the break-even point in value will be fixed cost divided by PV ratio. What's the fixed cost? The fixed cost given to us is what? Is 90,000. Sorry, this is not Naira. It's supposed to be RS. 90,000. Now, if the variable cost is 70%, it means the variable cost to say 70%, it means what? 30% is left. Let's go back to the equation again. The variable cost to sell is 30%. Then out of 100, 70% is what? Is the variable cost. Then the remaining one is what? Is the other cost, which is the fixed cost. That is 90,000 divided by 30 will give us 300,000. The same thing with what we got in the earlier question. So the same question that was twisted to get this this question out of it. So we now say it. What would that do is what? We will now say 70 or 100 minus 70 will give 30. Then 30 will be what? What will be left there? That is, your fixed cost is 90 divided by 30. That is 70 minus, 100 minus 30. 70 is 30. Then divide by this. 90,000 divided by this will give us 300,000. Then break-even call. So they say break-even point occur at 60% of the capacity utilization. So 60% utilization is what? Is 300,000. Let's look at it here. Let's say X equals to 300,000 divided by 60 times 75 equals to 375. Why do we get this 60? 60 is the capacity they're talking about here. This 60% capacity. So break-even point occur at 60% capacity utilization. So it's 300,000 divided by 60 multiplied by 75 equals to 375. Now we can compute contribution, and when sales is 375, sales multiplied by PV ratio gives the word contribution. Then contribution equals to what? Sales multiplied by PV ratio. I will say it what? 375 times 30%. Of course, the sales to cost ratio is what? Is 70. That means the PV ratio will be what? 30%. Now, 375 multiplied by 30% will give us 112,500. Then the profit will be your contribution minus fixed asset. Of course, contribution is what? 112,500 minus fixed asset of what? 90. So the profit will be 22,500. That is how you go about it. It looks so trickish, but if you take your time, you'll be able to understand. Now, having done that, let's go into budgeting and variance analysis. Budgeting and variance analysis. Definition of variance analysis. Variance analysis is the comparison of predicted and actual outcomes. For example, a company may predict a set amount of sales for the next year and then compare it with predicted amount to the actual amount of sales revenue it received. Variance measurement might occur monthly, quarterly, or yearly, depending on individual business preferences. Now, what happens here is this. As business owners, as companies, as organizations, you what? You make your budget. And remember that budget are what? They're just predictions. You just predict that, okay, this is what you intend to achieve. You Say, okay, your sales will be this amount, your purchases will be this amount, you pay this amount for lighting, you pay this amount for insurance, or some expenses you cannot even get the accurate figure. So what happened is, at the end of the period, you discover that maybe what you projected is not the actual amount that has happened or that you have incurred. There's what we call variance, the difference between what you projected and then the actual amount that occurs, what call it variance. And there's need for to analyze variance, call it what variance analysis. Now, this analysis can be done whether it can be done on monthly basis, can be done on quarterly basis, or can be done on yearly basis, depending on what individual business preferences. Business determine the period in which they want to carry out their variance analysis. Now, why compare actual and budget? Why must we compare the actual and budget? One of the objectives of budgeting is to provide a base against which actual performance can be measured. This is only what doing if action will be taken as a result. So we prepare a budget so that we compare our performance with the budget. That's what we do. Then if we have prepared a budget and we're comparing a performance budget and there's a deviation, there's what a variance, what do? We must what take action. The second point says, in too many organizations, the production of result compared to budget is seen as the end of the world process. If no action is taken on the basis of management account, then there is little point in producing them and even less point in wasting management time discussing them. So what are we saying? So haven't prepare your budget, haven't incur your actual expenses, then haven't discovered their variances. There's need for you to what? To take action. There's need to take action to, otherwise all your effort will just be like what? You just be like wasting time. It'll be like a waste of time, waste of energy, waste of resources. So you must act on these differences or these variances so that you would make decisions that will help you in future. By identifying processes from preceding positions, we are better informed regarding the effect of our actions and have a clearer understanding of the effect of any future action we take. Knowing how much is being spent each month enables a manager to consider whether action needs to be taken to spend more or less in the future. So it helps you to work in planning. It helps you in planning. You know where you need to channel your funds. You know where, or you'll be able to see which expenditure heads you spend more money. Is it really needful? Can you do something different and still get the same result with less cost? Are you overspending your budget? Is it healthy to spend, or maybe you budget to spend 10 million on a particular budget and you're spending 12 million? You know that is not healthy. You must find out how to cut costs. And this cutting of costs must not be the detriment of the business. It must be cutting costs and then giving you the best result or optimal result. Cost of budget variances. That is, after preparing a budget, there are things that will cause this budget when it comes to preparation to be different from what you plan. So there are 4 key reasons, and it is important that good managers recognize differences because the action required may be completely different in each case. The 4 reasons are: 1, faulty arithmetic in the budget figures. That is, when you're preparing a budget, maybe in your calculations, you did not tap your figures rightly. Maybe you didn't punch it, whether it's using a system or a calculator manually. You don't add up your figure wrongly, and you add the figure wrongly, and then that will what? It will be a arithmetical error in your budget. And when it comes to actual implementation, of course, there will be variance because maybe you budget that you will buy something of 10,000 naira. Instead of 10,000, you wrote 1,000 naira, you omit 0. Of course, in the market, you will not see it because you have a budget of 1,000, they'll sell that thing for 1,000 naira. You still pay the 10,000 naira. Of course, you have a shortfall of what? 9,000 naira. That's what arithmetic. Faulty in the arithmetic in the what? Budget figures. Errors in the arithmetic of the actual figures. Yeah. You can also have errors when it comes to what? Actual recording of what really transpired. what actual expenses or actual income. Assume, okay, let me use the same example. You budgeted to spend 10,000 naira, of course, and then you went to the market and you bought that thing, same 10,000 naira. Budget was actual. Variance analysis, there's nothing like a variance. You have what you spend is what you got. But when it comes to recording, you now record, let's say, 1,000 naira. Of course, there's arithmetical problem in your actual. So that will cause what? Cause variance, cause difference between the budget and then what really transpired the actual. Then reality is wrong. Maybe what you predicted or your projection is wrong. I remember before 2023 or 2024, yeah, before the coming of this administration, things were a little bit cheaper. People prepare budgets for the year, and then suddenly, with the removal of fuel subsidy, everything got changed. So budget became useless. Little people had to go back and then readjust their budget. And then, so the reality has done on every organization. So when the reality is wrong, it will also affect what we call the budget variances. So we discover that what you budget is not what you get in the market. When it's what there's a wrong reality or there's a change in reality. Now, the next one is what difference between budget assumption and actual outcome. You may assume that, okay, the price of these goods will be this. And then when it comes to that very particular price in the actual, you say the price you work will be more than what you predicted. Okay, maybe you say, okay, the inflation rate will be, let's say, 10% or 2%. And then what happened if the inflation rate becomes 15%? That means your assumptions were wrong, and that will affect your outcome. These are what the four basic causes of budget variances. Now, categories of variances. Variance can be categorized into purchase variance, sales variance, overhead variance, material variance, labor variance, efficiency variance. And there's so many other ones. But for this class, we'll just look at this six. Now, key terms for variance analysis. Here are some helpful terms to help you gain a better understanding of what variance analysis. Overhead costs. Overhead costs can refer to what a business operating expenses, like rent for an office space or insurance costs. Companies may audit their operating costs to save money and help increase overhead costs. So we talk about overhead, we talk about the cost of running your business or operating your business, known as what overhead costs. We're giving that rent is one of the examples, as well as what an insurance that you pay. Then we have budget. What are budget? Budgets are financial plans that companies can use to allocate spending internally and prevent overspending. Like overhead costs, business may revise a budget as needed to ensure they meet set goals. So a budget is just a financial plan that you want to allocate your resources, how you intend to spend the money, and how you intend to generate that money, just like a futuristic plan of how you intend to get money and then how you intend to utilize that money in your business. As simple as that. Then variable price and rate variance. Variable price and rate variance refer to the changes in the cost of product or service. They can be unpredicted, and companies might change these cost value to reflect current consumer demand or supply. Then variable quantity and efficiency variance. Variable quantity and efficiency variance refer to physical difference between the company's actual input of material and labor and the amount of overall allowed materials and labor. So when you projected that, okay, you will use 3 man-hour or 3 man-hour to produce an item, and then you end up using 5 man-hour, that's what a variance. You use more than what you budgeted. So we call it what efficiency variance. That's the difference between the inputs of your material and labor and then the overall that is allowed. Now, fixed budget variance. Fixed budget variance refer to the physical difference between fixed overhead costs, including in the company budget, and the actual amount of overhead costs for the variance period. So what we're saying, when we have the fixed budget variance is what? what they actually projected to be fixed, and then you have a difference when it comes to what? To reality. And we have fixed volume variance. Fixed volume variance is the physical difference between the amount of fixed overhead costs a company applies during a various period and then the fixed amount of recorded overhead costs in a company's budget. So volume, talk about volume, quantity. What we recorded is different from what. Now, type of variance analysis. Remember, we talked about what? Material variance. Material variance helps company identify where they may be using more materials than they actually need. For example, if a company reorder material because of quality concern, the additional cost may show variance in the analysis. Now, there's something that we could not touch when we were discussing inventory management. Inventory management is very broad. We don't have the luxury of time to cover everything. Let me just say something here briefly. When we talk about inventory, normally as a business, you have to devise um, some level of inventory that you need to keep. We have the minimum stock or the minimum inventory, now the maximum stock, the maximum inventory. Then you have the order quantity or reorder level. What do I mean? The maximum level of inventory is the quantity that you are allowed to have in stock as a business. Because when you have more than you need, it will cost you a lot. You have what we call stock cost. So it will be additional cost to you. Let's assume that you have the capacity to handle, let's say, 1 million um, units of stock comfortably in your warehouse. And then you say, okay, you want to get 1.5 million. So the additional 5 million is what? It will cost you more because you have to look for another warehouse somewhere and you'll be paying for rent to keep those stock. So company have what we call the maximum stock level, and then they have the minimum stock level. When the stock go beyond, the stock level is the level at which the stock is not allowed to go below. For instance, if we say, okay, we want to keep a stock level of, let's say, 1,000 units, and anytime the stock is less than 1,000 units, we are what will be affected because it may actually affect our production. So we have to maintain between, have to strike a balance between maximum stock and then the minimum stock. We have to maintain a level between maximum stock and the minimum stock. Now that's what we call reorder level. That is the level at which it is advisable or it is wise to what to place an order. It's a level at which what it is advisable, it is okay for you to place an order. Now, when you place an order, you may not get when you place an order, you may not get what you place or what you order immediately. So it takes time. We call it lead time. The stock will not come to the warehouse immediately. Sometimes the process will take maybe 1, 2, 3, or sometimes a week. So all these things must be taken into consideration. So that brings us to what? Material variance. So material variance helps companies identify where they may be using more materials than they actually need. For example, if a company will order material because of quality concern, the additional cost may what show variance in the analysis. So what are we saying? The company still have raw materials in the warehouse, and maybe probably because the one they have in the warehouse they are of low quality. They want a better quality, so they will leave that material and then go out to what to source for other materials. That is what an additional cost. That cost that's will lead to what variance. Will lead to what will lead to variance will lead to difference between actual and then budgeted. The company might be or the company may use this information to determine whether to continue using the same material supplies or research for a new one. This analytical process can require the use of what? The following mathematical formula to find individual and overall variances. Now, quantity variance. Quantity variance is what? the actual quantity, that is what you actually used, multiplied by the standard price minus the standard quantity multiplied by standard price. Standard quantity is what is just like the projected quantity or the predicted quantity. So by the time you multiply the actual quantity multiplied by standard price, is the standard price is just the price that you fix, and then that's what the budgeted quantity multiplied by standard price. What do you have to do? What you have what called quantity variance. Then price variance is something as what actual quantity multiplied by standard price minus actual quantity multiplied by actual price. Can you see now? Talk about price variance. Look at the difference here. This is actual quantity multiplied by standard price. Standard quantity multiplied by standard price. Therefore, price variance, we're multiplying the actual quantity by standard price and then actual quantity by the actual price. So remember, we have actual quantity, we have actual price, we have standard quantity, we have standard price. Now the overall variance equals to what? Quantity variance plus the price variance. If you want to look at the overall variance, you add the two. If you want overall value of what? Of material. Quantity variance plus your price variance. Take note. I think this is one of the things you will get in your exam, an expo for those who are on the live this evening. Get something like this. You complete some variance analysis and then make some comments. Just by the way, let's look at this one. Material variance example. A clothing company is interested in calculating its overall material variance. It has an actual quantity of 30,000 pieces of fabric at a standard price of 0.65 naira per fabric and a standard quantity of 25,000 pieces of fabric at an actual price of 0.5 naira per fabric. This information allowed the company to first calculate its what? Quantity variance. Look at it here. Let me just explain this question. This is the actual, this is what really was produced. Now, and this is what? The price that was set, the predetermined price, the budgeted price. And this is what? This is the standard. This is what they projected that they will produce. That's the projected or standard quantity they will produce. And this is what? This is the actual price that they incur per fabric to get this. Now we're asked to what? The quantity price or quantity variance is what we say. If you look at the first formula here, quantity variance will say the actual quantity. So here, actual quantity is what? Is 30,000. Of course, here. Then multiply by what? Multiply by standard price. So standard price in this question is what? Look at here. Standard price is what? 65 naira. So 30,000 multiplied by 65 naira minus, let's go back to the formula. Standard quantity multiplied by standard price. So standard quantity is what? 25. Standard price is what? 0.65. By the time you multiply this, you get 19,500 minus 25,000 times 65 could give you what? 60,250. When subtract 19,500, 16,250 from 19,500, you get 2,250 is what is the quantity variance. Now, the company uses what? Those numbers to calculate the price variance. Of course, from here, our price variance is what? We said actual quantity multiplied by standard price. So here, what actual quantity is what? 30,000. Standard price is what? 65 kobo. Then subtract actual quantity multiplied by actual price. So actual quantity is 30,000 multiplied by actual price 50 kobo. We multiply this, we get 19,500. Then this 30,000 multiplied by 50 kobo will give us 15,000. By the time you subtract this, 30,000 multiplied by 50 kobo will give us 15,000. By the time you subtract this, 15,000 multiplied by 30,000 will give us 15,000. By the time you subtract this, 15,000 multiplied by 15 kobo will give us 15,000. 15,000 from 19,500, you get 4,500. Finally, adding the quantity variance of 3,200 and the price variance of 4,500 provide the companies with what total or the overall variance. So overall variance equals to what 3,250 plus 4,500 give us what 7,750. This means that the company has what an overall material variance of what 7,750 naira. That is what the variance. Now, let's look at labor. The labor variance help business identify how efficient they use labor and the effectiveness of their pricing. For example, if a company calculates variance and finds inefficiency or higher labor pricing, it might consider making changes for the upcoming fiscal year. This information may help the company further streamline its operation and save money. Here are the formula involved in finding individual and overall variance for labor. Now, why do we calculate labor? Why do we calculate labor variance? It helps the management to what? To find out who are those staff or who are those employees that are not productive, they are inefficient, or they are the one that result in high labor pricing. So if you are not efficient, it means what? All the money you're receiving is a waste. So it will just add up to the cost of labor, but there's no commensurate productivity from your own end. So it will lead to what? A higher labor cost without commensurate productivity. So the company may decide to change in the next fiscal year. Maybe they say, okay, they will now sack the staff and then bring another one, or probably the staff needs more training. It's okay. Maybe reason why you're inefficient, you don't have the skills, you can put in for training. Any way they can decide to do, anyhow they can decide to do it. So, but what they're trying to do, they're trying to make adjustment for the next fiscal year. So we have rate variance, and we have efficiency variance, and we have overall variance. So the rate variance is what? The actual hour multiplied by the actual rate. Of course, if you look at this one, it's almost the same thing. Same thing with this one. Actual. So we said actual hour, and is the hour that you spend, the employees spend in production, multiplied by how much you pay the person per hour, then minus the actual hour, then multiplied by the standard rate, how much did you projected that you pay him. Then we'll talk about the efficiency variance. You say the actual hour multiplied by standard rate, then subtract the standard hour multiplied by standard rate. By the time you add the rate variance plus the efficiency variance, you have what? Now the overall variance. Now we have the labor variance example. A construction company wants to calculate its overall labor variance. The company actual hours are 5,000 at an actual rate of 15 naira per hour. And the standard hours are 4,800 and a standard rate of 12 naira per hour. Using these numbers, the company calculates the rate as follows, or this variance as follows. So we look at from the formula we have what? Rate variance equals to what? The actual hour, which is 5,000, multiplied by actual rate, 15 naira per hour, minus the actual hour, that's 5,000, multiplied by the standard rate, 12 naira. So multiply 5,000 times 15. Of course, that will give us 75,000 naira. Then 5,000 times 12 naira, that will give us 60,000 naira. By the time you subtract 60 from 75, of course, that will give us what? 15,000 naira as what? As the rate variance. as a rate variance. The next component calculate what the efficiency variance. So efficiency variance is it what we say is the actual hour multiplied by standard rate, then the standard hour multiplied by standard hour. And so actual, let me just take it again, sorry. Efficiency variance what? The actual hour multiplied by standard rate minus standard hour multiplied by standard rate. So 5,000 of actual hour multiplied by 12 naira standard rate equals to 60,000 naira. Then we have actual hour of 4,800 multiplied by, standard hour of 4,800 multiplied by standard rate of 12 naira give us what? 57,600 naira. So by the time you subtract this 57,600 from 6,000, will give you 2,400 naira. Finally, the rate variance of 15,000 and the efficiency variance of 2,400 provides the company what? With its overall variance of what? The 2. That is 15,000 plus 2,400 give us 17,400. The labor variance outcome of 17,400 may be unfavorable if the company didn't expect to spend that additional money on labor costs. Company may choose to review its labor cost and plan to ensure it does not overspend in the upcoming fiscal year. Yeah, because from this one now, it's not favorable because you're spending additional 17,000 to pay your labor, to pay for labor. It's not favorable at all. So the company has to sit down and look, what is the cause of all this? Are we overstaffed? What's really happening? Is our rate too high? So you all sit down and then analyze and see how they can come up with a better labor cost that will not drain their finances. Now we have fixed overhead variance. The fixed overhead variance helps a company identify difference between its budgeted overhead costs with which it may determine based on production volume and then the number of use overhead costs. For example, if the company wants to revisit its budget plan, it might use fixed overhead variance to determine whether it can reduce its current allocated budget. This information may help the company save or allocate money to other areas of the budget or the business. Here are the formula involved in calculating fixed overhead variance. Now we have budgeted fixed overhead costs equals to what? Denominator level of what? The denominator level of activity times the standard rate. Then we have budget variance, which is actual fixed overhead minus budgeted fixed overhead cost. We have fixed overhead cost applied to inventory equals to what? Standard hour multiplied by standard rate. Then volume variance equals to what? Budgeted fixed overhead cost less fixed overhead cost applied to inventory. Then the overall variance equals to what? Budgeted variance plus the budget variance plus the volume variance. These are formulas that you need to get them handy so that when you have questions like this, you'll be able to use them. If you have the formula, it is not difficult to work it out. Now, the fixed overhead example, we have Wheeler PR is a marketing and public relation agency that wants to find its overall fixed cost or heads by head variance. The national level of capacity is 8,000 hours at a standard rate of 10 naira per hour and 6,300 standard hours at an actual fixed overhead cost of 82,200 naira. So this is a company and they have what? They have a fixed overhead. They have the capacity to produce or to use 800 hours. That's what their budgeted hours that they will use. The company can run for 8,000 hours. And the standard price is 10 naira per hour. And 6,300 standard hours at an actual fixed cost of 2,000 naira. So this is what we are giving here. So multiplying the denominator level of actual of activity of 8,000 naira hours, 8,000 hours by the standard rate of 10,000 hour provide we now PR with what? Budgeted fixed overhead cost. So we now say, okay, the budgeted fixed overhead cost goes to what? 8,000 multiplied by the 10 naira. This is the 8,000 here multiplied by the 10 naira, give us what? 80,000. Company then calculates what? Its budget variance. Now the budget variance equals to what? This is what we have here. The fixed cost is 82,000 naira. And this is what? Now, this is what the standard hour at this is standard hour. This is what they actually use. This is what was projected. This is what they actually use. Now they have 2,200 naira left. Next, the Wheeler PRs finds the fixed overhead cost applied to inventory. These are formulas that we're using. So the fixed overhead cost, applies to inventory equals to what? The 6,300, this very one, which is what the standard hours multiplied by the standard price of 10 naira. That will give us what? 63,000. Then the volume variance equals to what? 80,000. Yes, this 80,000 that we got here, subtract 60,000 from it, you get 17,000 naira. Then finally, the budget variance of 2,200, which is this one, and the volume variance of 17,000, which is this one, provide Wheeler's period with what? Overall variance of what? 2,200 plus 17,000 give us what? 19,200. From this calculation, Wheeler determined that it has an overall fixed variance of what? Of 19,200. So don't mind about the naira or the dollar sign. How are variance calculated? There are two important rules. The first rule is to what? The level of variance should be decided by the needs of the decision maker, not the convenience of the reporter. So to decide the level of variance. And secondly, the budget must also be what? Fixed, or must be flexed for what? For changes to produce realistic variances. But this is how we calculate our variances. Now, let me just say something quickly here. The variance can be favorable and they can be unfavorable. When a variance, let's assume that you have a budget that you spend 10,000 naira for lighting for an accounting period, and then you end up spending 12,000 naira, and you spend above the budgeted. Of course, that is a variance. That variance is unfavorable. This is one way. And for instance, and you budgeted that you will have an income of, let's say, 200,000, and you got 250,000. That is what a variance. In this case, the variance is favorable because it adds more revenue into your coffers. So variance can be favorable or unfavorable. Take note. Look at this example. This is the sales volume. The budget is what? That we're going to make sales of 1,000 units. And then we come to actual, we got only 900. Now, if I may ask, by me looking at this is what? This one is not favorable because we budget that will sell 1,000 units, but we end up selling 900 units. Of course, the shortfall of what? 100 units. This is not favorable because our budgets of sales, so that sales is what? It's a revenue. When there's a fall in revenue, of course, it is what? Unfavorable to the business. So this is 900. The next one is what? The sales value. We said, okay, the value will be 10,000, but we got 9,000. Of course, still not favorable. Now, the variable cost, this is cost now. We will plan that we incur 5,000 naira as our variable cost. We will end up incurring 4,950. Yes, there's a variable, but this variable is what is this variance is what is favorable because we incur less than what we projected. So we're saving what? 15 naira from our forecasted projected cost, variable cost. Now the cost, the fixed cost, we said, okay, fixed cost will be 2,000 naira. We'll end up spending 2,100 naira. This is not favorable because we spend above our budget. Then the profit, we said, okay, at the end of the day, sorry, don't mind about the spelling. It's supposed to be profit, no E. The profit is supposed to be what, 3,000, and we end up spending, and we end up getting 2,850. Of course, this is not favorable because there's a shortfall in our profit from what, from when we budgeted, from what we forecasted. Now, this is an example, and look at how we can work it out. Work it out. Now, the sales units is the actual, it's master, but this is the sales unit. Now, sales unit is how much? We say it is what? Sales unit is what? This is actually is what? 80,000 is a master budget of what? Of 100,000. This is the actual, this is a master budget. This is a budget of 100,000, but our sales unit got only 1,000. And we budgeted that our sales value will be 1 million, and we got 840,000. Now we have this variable costs. Variable manufacturing costs, budgeted that we spend 380,000, but we spent 329,690. Of course, this is favorable. Then we have variable selling and administrative cost. We budgeted that we spend 90,000, we end up spending 68,000, which is good. At least we save costs. When you add these two, total variable cost is what? 397,680 up to actual against 470. Of course, there's saving here, which is favorable. Then contribution margin, we have what? 442,320 as actual, but our budget shows that we had 30. That is also not good. Then we said fixed manufacturing overhead. Our budget was for 200,000 naira, but the actual was what? 195,000. Then the selling and the administrative costs, fixed selling and administrative costs, we have what? Budget was 140, but we end up incurring 132,320. And when you add up the total cost, the total fixed cost, you have what? Just this plus this, you have 327, 830, 820 against 340. Of course, look at our profit. The budgeted was 190,000, but we end up getting 114,500. Let's look at this calculation. Now, calculation for master budget. If we look at this A here is just for explanation purpose. 100 units, 100,000 units multiplied by what? By 10 naira per unit. That's why we got this 1 million. Then B here. B, if you look at B here, look at it here, is 100 units, 100,000 units multiplied by 3,000 and 3 naira, 3.8 dollar. Will give us what? 380. If you look at C here, where's my C? Where's my C? Okay, 100,000 naira divided by 0.90. This C here, I got 90,000. That's how I got 10,000 dollar. Now let's go to the workings. Look at the solution here. We have the master budget, and we have the variance, we have the actual. So what do? We're comparing the master budget and then the variance. What do? We now say, okay, this is the master budget. We said we're going to sell 100 units. We end up selling 80 units. What's the difference? The difference is 100,000 minus 80,000. I'll give us what? 20,000. Now, after taking the difference, we now say, is this difference favorable or unfavorable? Because in our budget, we say we will sell up to 100 units, but we end up selling less than 100 units. By what? By 20,000 units. This is what we call the variance, but this is what? Unfavorable variance. That's why I use U for what? Unfavorable variance. It's not favorable. Now, the same thing we say, okay, we say that our sales will be, in value, will be 1 million. We'll end up getting 840,000. Then 1 million minus 840, you get 160,000 naira. This is also a variance which is what unfavorable because our projected revenue is what we actually got is less than what we projected. So it's what unfavorable of 160. Now go back to these items one after the other. Look at cost, variable cost, variable manufacturing cost. We say we'll spend 380, 29, 680. What do we do? Subtract 329, 680 from 380. We got 50,320. Of course, this is what favorable because we are saving money. We're saving money from 350. We just spent not 329. Of course, we're saving 2,320. This is what favorable, which is F stands for what favorable. Now the next one says variable selling and administrative costs. We budgeted to spend 90,000, but we spend 68,000 naira. We're saving 22,000. This is what is favorable because we're saving costs. Now total variable cost equals to the 470 minus 397. We got 72,320, or you add these two. And 2,320 is what is favorable. Now, our contribution margin is what we said we are going to get a contribution of 530. But we got a contribution of what? 442,320. Of course, when you subtract this from this, we get 87,680, which is not favorable because our contribution is very low, lower than what we budgeted. Now, the fixed manufacturing overheads, we said we incur 200,000, but we end up incurring 195,500. Of course, by saving 4,500, this is what favorable. We said fixed selling and administrative cost. We said we're going to incur 140, but we incur 132,320. We're saving 760, 7,680. Well, this is favorable because we're spending less than what we budgeted. Then total fixed cost, of course, 340 was the one that we budgeted in the master budget. We end up spending 327,820. Of course, we are saving 12,180. This is favorable. Now let's look at the profit, the last item. In our budgeted or in our master budget, we said we're going to make a profit of 190,000. But in reality, what do we make? We made 114,500. We subtract this 114,500 from 190, you get 75,500 naira. This is unfavorable because our forecast or our actual profit is less than what we budgeted. So it's not favorable for the business. That's how you do what? You do ratio analysis. All right. Any question? Mr. Adeoye, are you there? Any question? So that
Hello,
is it.
sir.
I say any question on this?
Well, none for now, sir.
All right.
Thank
So
you very much.
we have like 3 topics. I don't know. Even though 2 are theory, which we can finish in a day. I don't know. Can we continue so that maybe just take one of the topics, or we'll leave it till Tuesday? What do you think?
Let's leave it to Tuesday.
All right, that's okay. That's fine. So I will share this material
Okay,
WhatsApp platform. Then on Tuesday, let's see whether we'll be able to round up 2 topics, and then Thursday we'll round up everything. Then
okay, sir.
take for your exams. Good night. I'll see you then.
Thank you very much. Thank you for your time. Thank you.
You're welcome.